before they reach the retirement age?
Okay. Thank you, Anthony. So usually when we talk about retirement, the first thing that comes to mind is the age. We usually think that retirement is all about somebody getting old and tired and therefore leaving permanent employment. That is true to the greatest extent. So when you have been saving for retirement with your retirement benefits scheme for any number of years, one, you can access when you make the age. For example, the mandatory NSSF scheme, you can access when you make the age at 55. So when you make 55, you go through the necessary processes and claim your benefits, age 55. Yeah. Public service, it's age 60, and they also have their own processes. Now, there are other circumstances where somebody can access their retirement benefits savings before, which are not necessarily tied to the age. We have the immigration benefits. For example, if today I got a job, another job maybe outside Uganda, and I'm going to migrate permanently, maybe some faraway island in the Caribbean, and it will be so far away from Kampala. So, and I'm not going to return, I can claim my benefits on account of immigration, that I'm no longer, I've gained citizenship somewhere else, and it's no longer going to be possible for me to save within Uganda or live within Uganda. There may be circumstances also when somebody gets a debilitating disease or a situation that really puts them in a position where they can no longer work and save meaningfully. Maybe somebody suffers an accident and they suffer a disability and they are put out of work. Yeah. Under such circumstances, there are also procedures that are clearly defined in the law that one can follow to access their benefits. Sometimes also on the account of age, especially those that save with the mandatory NSSF, you may make age 50 and then you're not able to get another job. Let's say you look and look and look, you're between 50 and 55, but you've not been able to get another job. Once you prove that, again, the process can be organized so that you can also access your benefits. The other circumstance about death, when somebody dies, it means that they're no longer able to work, obviously. No. Yeah. So their beneficiaries who are nominated when they were registering for the scheme can access those benefits when the actual saver has died. But we also have the midterm access, which came in effect with the recent amendment to the NSSF law. Midterm access, which was a very popular provision, when somebody has been saving consistently for 10 years and they make age 45, they can also now access a part of their benefits, 20% only. So when usually we talk about age, but you know, there are all those other circumstances. The other circumstances when, for example, you move jobs again, if you have been, let's say, working in a private sector organization and then you get into a job with the public service, which means that now you're going to become a member of the public service pension scheme, there you may also access your benefits. Those are the different circumstances under the law. Yeah. Yes.
Oh, that's interesting. Maybe just to get a recap, because these are very important. We have the age, the 50 years.
Yes.
We have the disability.
Yes.
There's death.
Yes.
Then the midterm access.
Yes, and immigration.
And immigration.
Yes.
Those are the only circumstances you can access within.
Early access.
Early access.
Okay. If you reach 55, definitely you've reached age, you can access. Yeah. But usually people are interested in how can I access my benefits before I make that 55. Actually, that's where you started before the break. That what if, do I really have to wait for age 55? you should ideally you should wait for age 55 if everything is going well, you're not sick, you're not migrating. You should wait for age 55.
Is sickness
55
part
is,
of it?
55 is not such a long
Yeah.
age. I talked about it.
Sickness,
If you
okay.
get a debilitating
Yeah.
illness that puts you out of action,
Yeah.
you can also apply to access your benefits. Yes.
Wow. My last one to you before I go to Mr. Lotuke is the 50% access. Access to 50%,
Yes.
if I could say that.
Yes.
This was the regulation, and we were discussing during the break that people still don't understand this. Maybe it hasn't actually been implemented, but the act was amended to give us access to 50% of the savings that is as collateral to be able to access the mortgage. Is that right?
Yes. Under UBRA regulations, I think it was May last year when we issued a new regulation allowing or enabling savers to assign 50%, up to 50% of their accrued benefits to housing loans or mortgage. So if you have been saving for many years and you have accrued so much money and you want to get a housing loan, it should be for housing. And what were we trying to cure? We were trying to cure the problem of people retiring and then starting to construct residential homes at that age of 55 plus.
So you're using all their benefits to
Exactly. They use all their lump sum to construct a house. Sometimes it's not even enough, So that's what we're trying to cure, to ensure that people have decent accommodation before they retire. When they retire, they already have a decent place to go to. Of course, if you already have decent accommodation, there's no reason why you should try to, assign your benefits. Okay, maybe you may have a reason, but ideally, it should be so that you prepare a home, a decent home when you retire. So it's really for housing loans and for residential, okay, either mortgage or a housing loan. You assign up to 50% of your accrued benefits, and there's a fully defined process to that also in the regulation, so that you're able to prepare for retirement that way. So that's one of the key UBRA regulations that have been recently issued.
What if I want to upgrade to a posh house? Yes, I want to retire, but I want a better house that I'm currently having. Am I also catered for in this regulation?
It's a residential house.
Okay.
Yes.
Limited to that.
We do not, the law, the regulation is not so that you can get a loan, a housing loan or a mortgage so that you can build business premises. No. We want to cure that homelessness in retirement. Okay? Yeah. So that is what the regulation is about.
Interesting. So very interesting. I think all the people who work at UBRA are quite very disciplined and disciplinarians. You don't play around with all this, people's money, because at the end of the day, as the regulator, you oversee all these pension schemes, and you keep an eye on them. You keep an eye on the funds. You keep an eye on the investors. You keep an eye on all these fund managers. So I think the discipline just grows and kind of is inculcated.
That's the whole purpose of regulation and supervision, so that you ensure discipline in the sector, compliance to standards. So I actually forgot to mention about that, the regulation on housing loans and mortgages. You don't borrow them. It's not like you go to your account and get that money out. No, you use it as collateral.
So you go to a bank.
Exactly, you go to a bank and that is what you put as collateral. So your scheme gives you, let's say, the comfort letter, that you present to the bank to give you the facility that you want.
And it has to be enough.
It depends on your savings. It depends on the savings you have accrued. If you have accrued enough savings to be enough to fully construct your residential house, so be it. So we don't know what's enough because we may not know everybody's dreams. But enough is relative. Yes.
Interesting. Thank you for those insights. I'll come to you, Mr. Lotuke. She brings very, very big points here. And as the senior supervisor here, definitely you can always give us some bit of enlightenment, especially she mentioned the trust deed. My thinking was that there is one document or one set of guidelines, and every pension scheme follows that. But according to her narrative, the pension schemes have separate trust deeds, which probably they are formulated, they formulate on their own under your supervision, of course, and then the members of that scheme follow that. For example, I didn't know personally that the midterm access was only applying to NSSF. So talk about these trust deeds. Who formulates them? First of all, who gets to formulate them, and why isn't it uniform? Shouldn't it be uniform so that people just know that the moment I join a pension scheme, I expect midterm access, I expect the 50%, and all those other benefits that are coming from all the other schemes? Isn't it better that way?
Thank you. Actually, the regulations and the act that cover all the operations of retirement benefit schemes is done provide uniform rules. What Lydia meant is that each and every scheme has what we call a trust deed and scheme rules that are particular to that scheme. But the clauses or the items in that trust deed all comply with what is in the law. They comply with the various regulations that UBRA has already put in place. Why each scheme will have their own trust deed is because there are certain things that will be unique. For example, for the NSSF, or basically across all schemes, the rates of contributions may never be the same, right? The retirement age, just like, for example, public service retirement age is 60, NSSF, you access benefits at 55. So those will be unique. So there is a section called rules that defines things that are unique to that scheme. It's even where trustees will put things like, for us, we will pay benefits in 2 weeks, rather than say in 1 month. But so if the regulation, the OBRA regulation says 60 days, for example, on something, then in the different trust deeds, another one can say 40, another one say 20, but you cannot get one saying 70 because that will be non-compliant with the regulations. So the regulations, the minimum, but they can put something better. So each scheme, basically, 90% of the trust deeds will have common things, but there will be those unique things. So now even the way the design of the benefits, if they have a particular benefit that they have designed, which is only particular to that scheme, that's why we say they will amend their trust deed to indicate that now they have that particular benefit. But it's not like every scheme operates by its own rules. It's only those unique things that are different.
Well, still talking about the trust deed, you mentioned that there's the regulation, but then it can't be exceeded, but everyone has some space to play around. The gratuity, I don't know what these terms really are, and I'm sure the viewers sometimes agree with me as well. There's a gratuity, then there's a lump sum. Do you regulate that as well? Because I've seen schemes that say, okay, we give you all your money at the end of your, the retirement age, and then some give it to you in portions. Is there a space to regulate that, or there's actually one regulation to actually cater for all that?
Now, in terms of how schemes pay benefits, that is it is determined at the point the scheme is established. For example, the NSSF Act establishes NSSF as a scheme which pays a lump sum. The Public Service Pension Scheme is established as a scheme which pays a pension. And then most of the occupational schemes are established to pay a lump sum when someone qualifies. So, meaning that's why we have a pension scheme and what we call a provident fund. Provident fund is the one which pays a lump sum. NSSF is one of them, and most of the other occupational schemes. And then we have pension schemes. Currently, we have 3 schemes that pay pension, which is the Public Service, Bank of Uganda, and Parliamentary Pension Scheme. Those pay pensions. That is regular payment, monthly payment. But as a regulator, of course, as I said earlier, the most reliable cash at retirement is through a pension. Therefore, it means a lump sum is not always a good option. But also, being that the current arrangement provides for lump sums, we now try to make sure that the players in the sector are innovative and flexible in terms of how they operate, to be able to come up with other products that can convert this lump sum into a pension. So if you get a lump sum from your scheme, you should be able to have other avenues of converting it into a regular payment. And one of them is what's called an annuity, which is a product provided by insurance companies, where you give them a lump sum and you say, I want to get this amount for this number of years. And then they will apply a certain rate and they will tell you from the time you want to get and your age and the amount you put, this is what you'll be getting monthly. And of course, they will be investing, so it will be earning some money for you. But also schemes are innovating around what is called income drawdown, where you still give them that lump sum, they will be investing it. So if, for example, 100 million and they tell you they can be earning for you 10%. So you tell them, at the end of the year, if you have earned 10 million from 100 million, give me that 10 million and continue investing. So you'll be drawing the income only. Or you can say you will draw the income and a small portion of the principal as well, depending on how long you think you want to exhaust that amount. Because when people get a lump sum, someone said you get like temporary insanity. Like someone has been receiving maybe, say, 2 million every month, but has saved 10% of that portion, or 15%, that's about 300,000 every month for 20 years. That amount can go to even $1 billion.
Yeah.
And then you get that $1 billion at once. It has never occurred to you that it does. So someone will say, now I'm going to buy a house the other side, I'm going to plant avocado the other side. Then before you know it, everything just disappears before your own eyes. Yeah.
And I think as we wind up the show in the next segment, we are going to definitely address that issue of misuse of money, especially by the pensioners when they finally get to reap from that. Coming back to you, Miss Lydia, there's a point of debt. I have to say, many people are indebted, and sometimes it's a trick. It's tricky to balance between paying off debt and saving for investment and so many other things. What do you think people can do to balance the saving, especially for retirement in this case, with paying off debt? Because at the end of the day, you don't want to retire and all your lump sum, whatever amount you're getting from the benefits, is going to debt. How can people especially come out of the debt trap that, for example, currently Uganda is trapped in? We are currently having over 50% of our GDP in debt. And we are still living, yes, but it's worrying, right? And now this can be to an individual, and someone is retiring in debt, totally in debt. And they're getting all these pension funds and they're putting it in the debts. How can they balance that off so they can avoid such circumstances?
So, actually, I have an auntie who once told me that the most uncomfortable pillow to sleep on at night is the pillow of debt. When you have debt, you are so weighed down, you can't sleep.
Yeah.
You basically can't focus well, and because it's worrying you. And we have seen this even before we retire, before we think about retirement. People having excessive debt is a very common occurrence in Uganda. We've seen people being swallowed up by loan sharks because of poor or ineffective debt management. Now, our advice is, as you start moving towards retirement, start clearing your debt. Retirement is not an event that just happens on a day. It is a journey. It is something that we walk towards. We walk towards retirement every day of our life. So we know that it is coming and it will come at a certain age. Okay? And we are able to nowadays, we are able to calculate, make calculations. How much will I have in my account? Things like that. So as you walk that journey towards retirement, it's very important to clear your debt. We advise people, do not get into retirement when you are indebted. Because when you retire, you're going to stop earning that regular income. Which means that the little that you have or the much that you have saved will really be to sustain you in your retirement. We are told that an average person, if everything is every factor remains constant, will spend at least 17 years in retirement. Now, think about those 17 years. If you start off when you're already deep in debt, will you be ever able to recover in the 17 years? Remember that your productivity has reduced. You probably don't have a permanent job, So it's important that you retire when you have cleared your debts. How? And now, I may not have the magic bullet, but it all goes back to personal financial management. If you have taken a loan from someone, from an institution, work out a payment plan which will ensure that you do not reach your retirement date when you're still paying off that. In fact, we are not supposed to use our retirement benefits to clear debts. It should really be to sustain us in retirement. So clear your debts before you get into retirement. And when you get into retirement, avoid getting into new debts. But this all comes back to how able are we to manage our personal finances. Financial literacy is very, very important. We need to educate ourselves on how to manage our finances. We need to get financially literate. How do you manage debt? How do you manage investments? How do you draw your day-to-day budget in such a way that you're not burdened? This all comes back to our individual financial literacy. And nowadays, it's very common in Uganda. Financial literacy is going on in every corner. Everywhere you look, there's a webinar coming up, there's a journal coming up, giving you information on how to better manage your finances. Newspaper columns, TV shows. Let's educate ourselves. There we shall get knowledge on how to manage our debts and how to manage our finances in such a way that we don't get overburdened by debt. So it's something, we're not saying that you don't take credit. We all know that we need credit at a certain point in our lives. But make sure that you clear your debt at least before you get into retirement. Then you will not be overburdened. So get information, work with professionals. There are so many professionals around us. Mark talked about the professionals in the retirement benefits sector. But there are so many professionals also in other sectors, capital markets, investment analysts. Work with them. The problem is many of us tend to get advice from non-professionals, our friends who think they know it all. If you talk to them, they give you advice, join this scheme, join the other scheme, invest here, they calculate for you when they are not professionals. Please let's make use of professionals available to us so that we avoid some of these mistakes. A professional will tell you how to organize yourself, you organize your finances so that you are debt-free by the time you get into retirement.
Wow, basically get a financial advisor to get you through your financial journey. Very interesting. Thank you so much. We are going to take our last break and we return finally with our final segment. You don't want to miss out on this one. We are sharing, first of all, some of the common mistakes you make when you're planning for retirement and how we can address them. Also, she pointed out financial literacy. When they give you this lump sum of money, how are you going to spend it? Mr. Rotuke mentioned the billion shillings. I don't know if there's any saver there who has made 1 billion shillings, but I believe they are there who have even made more. What are you going to do with all this money? How can you plan so that you don't actually retire into a lot of money and you end up misusing it and actually ending up with nothing? My name is Anthony. We are returning shortly. Stay with us.